Good afternoon, guys. I hope we're all well. Panelist. Perfect. We're just inviting Arthur on now. By the looks of it, Zoom is working. I'm not entirely sure what happened yesterday. Never happened before, but today we are looking good. So how's everybody doing today? You had a good day? Ready to learn about capital allowances, save some tax, put your hands up, say hi in the chat. Let's get talking. Any questions you've got at all around capital allowances, get them in so we can get them answered by Arthur. Hi there, Paul. How are you doing? Thank you very much for joining us today. We had a couple of questions come in from people, partly from yesterday's session and again in advance of today's. So we'll just load those up so we've got them ready to run through with Arthur at the end of the session. Okay, perfect. Good evening, Scott. How you doing? I hope you're well. Download version. I'll see what I can do, Peter. See if we can put this somewhere for our clients. We've got a new online platform that's being built that we give clients access to all our previous webinars and loads of other tax saving stuff, which is where we tend to put stuff like this. I'll see if we can potentially look at distributing it another way. We'll have to look and see what we can do with that one. Okay, so let's see if Arthur, are you there?
Yeah, I'm here, Josh. How are you?
Yeah, I'm very well. And yourself?
Yeah, pretty good, pretty good. It won't let me share my video with you at the moment, so I think you have to unblock me for that.
That's something my side, isn't it? Who can share? There we go. If you should be able to share now.
Still not. No, it says the host has stopped it still. So not that people need to see me anyway, but.
You should be able to.
So start video, it says you cannot start your video because the host has stopped it.
If I make you a host as well. Are you able to share your screen at all? Or do you have any slides, or is it?
No, it's just purely talking. So it's not no slides or anything. Just talking through basically what to know on capital allowances when you're buying a property. So
I'm going to make you host and see if that changes anything.
You are now the host. There you go.
Perfect.
Another technical hiccup there to do with Zoom, eh?
Yeah. I think you'd have thought by now that we should have gotten the hang of it.
We're all Zoom experts, aren't we, the last couple of years or the last year or so, so it should be pretty straightforward.
Yeah, perfect. So I know you've got quite a lot to talk about today, especially kind of with capital allowances. It's a pretty fun subject. because often it does save people a lot of tax, as I'm sure people will be listening, making lots of notes. But yeah, in terms of kicking things off, I'm happy just to kind of throw the ball in your court and let's get stuck in.
Yeah, thank you. Yeah, so I thought it'd be a lot of questions, certainly since the last couple of months. Seems to be a really busy time of year, and it always has been with the tax return deadline. And of course, one of the things that people realise when they get to sort of November, December, January is that they've got a shed load of tax to pay, and people tend to look around for legitimate ways to avoid paying that tax. And one of the main things that people can do is, obviously, if they have the properties, claim capital allowances. So certainly a lot of the questions we've had over this year is more to do about how we can identify capital allowances when we see an opportunity, we want to buy a property, you want to invest in a property, what tax relief is available out there. So it's a question that I'm asked quite regularly. So I thought I'd just go through the motions of what to look out for, what to avoid, and just the various things that people should be aware of when they're actually looking to buy a property. So yeah, I'm just going to talk through a number of things. So first of all, I'll talk about what is the value of capital allowances. So when people are buying a property, it's always great to know for cash flow forecasting or profitability, to know what the tax relief is that's available so that you can then factor that into your forecasting. So we're going to go through the value of capital allowances on these properties, how much they're actually worth. We're also going to briefly discuss about how to get the capital allowances. There's a number of processes and kind of do's and don'ts and bits of information that people should be aware of when they're sort of negotiating with buyers, and sort of things to look out for there, which will determine if you can claim capital allowances or not on the property. And then towards the end, I'll go over very basically the overall process in terms of, in the initial sort of part of finding a property, deciding if that's the property you want, what the capital allowances options are, and then right through until the numbers in your tax return. So just to sort of talk through that process on there. So the first thing, when obviously somebody's found a property, is to go, okay, what is the value of the capital allowances? If there's capital allowances available to me, potentially what is the value of those allowances? Now, there's a couple of things we should be aware of. The value of the capital allowances is dependent on the number of different things. One, or primarily, how you're buying the property. So if you're buying it in your own name or through an LLP or through a joint venture or partnership, then if you're owning it personally, then the tax rate could be anything from 20 to 40%, 45% on there. So the value of capital allowances is dependent on who's buying the property and also the type of property that you're buying as well. Certain properties attract more capital allowances than others. So I'm sure you can appreciate if you're buying a warehouse, for example, a lot of that's just fresh air. So there's not an awful lot of capital allowances available. And when I talk about capital allowances, it's generally all of the second fix items. It's these things called plant and machinery, which have been detailed in case law for about 145 years now. And the case law determines items which are things of plant and machinery which are in properties. Typically, or to kind of generalize, it is the second fix items in a property. So if you imagine, once you've built the structure for a property, it's kind of everything that goes into a property to make it work. So it's generally sort of heating, wiring, lighting, sanitary ware, bathrooms, kitchens, etc. All of those things that make the building work is what is deemed to be plant and machinery. So the value of those depends on, as I say, who's buying the property, because that determines the tax rate and the type of property that you're buying. But by far the biggest sort of factor is the purchase price of the property. Certainly when you're buying second-hand properties, there's a whole host of calculations that we have to go through, and the biggest determinant is the actual purchase price of the property. So what we do is we break down that purchase price into its component parts, and the part that is relevant to the plant and machinery, once we do our surveys, that is the value of the capital allowances. As a rule of thumb, it's typically going to be about 20% of your purchase price is going to be the plant and machinery value. So if you're buying an office for £200,000, there's going to be about £40,000 worth of tax relief there. And if you're buying it in your own name and you're a high rate taxpayer, 40% taxpayer, that's going to save you roughly £16,000 in tax. So you can imagine your sort of net investment in that property. You could look at it as saying, well, hold on, I'm buying a £200,000 property, but as part of my tax return process, I'll be getting £16,000 back or saving that in tax. Therefore, my net investment in the property is obviously a lot less. So they have the potential to make a massive difference on these properties. Now, I've talked about plant and machinery allowances, but something else which has come in the last few years, sort of in line with the rest of Europe, is something called structure and buildings allowance. Now, structure and buildings allowance is only for commercial properties and is a tax relief based on the value of the structure of that property. So across Europe until fairly recently, well, across Europe still, businesses and individuals are allowed to claim capital allowances, this structure and buildings allowance, on the actual value of the structure of the property at a small percentage each year. And they've introduced that here in the UK as well. So if you're buying a commercial property, not only can you claim the plant and machinery, the second fixed value, but you can also claim the structure and buildings allowance as well. And that can be, say, 40% of your investment could be an additional tax relief. Unfortunately, you don't get those all at once. You only get them at 3% a year. So if you're buying a £200,000 office, for example, you could get £40,000 worth of plant and machinery allowances, and you could also get, say, £80,000 of structure and buildings allowance, survey dependent, of course. And that £80,000 will be available to you at 3% a year until it's all used up. So not huge amounts, but over the lifetime of a property, it's make a massive difference to your investment. So that's the two main things when we talk about capital allowances when you're buying a property. The other one I will just say as well is land remediation relief. Now, some people, when they're buying properties, they might be buying properties that are known to have asbestos in them, or Japanese knotweed, or some other sort of land or some sort of contaminant that has the potential to do harm. It's another very valuable tax relief which is available to people buying a property. So very often people will buy a property and they'll find out that it's got asbestos in it, and that will put some people off. But knowing that there's this additional tax relief called land remediation relief, you can actually claim 150% of the costs that you incur cleaning up that contaminant against the profits for your business. So they're the kind of three main things that we look at on a sort of daily basis, if you like. So knowing the value of the value of the property, how you're buying it, what sort of structure you're buying it, and the purchase price of the property, that will give you a sort of indicative idea of the amount of capital allowances that are available. So that's kind of the first thing to look at. So you've identified your property, you've looked at how you're going to rent it out, you know if it's going to be profitable, you forecast all of these things. You can even forecast in there the value of capital allowances and how much that's going to save you in terms of tax. And I guess it's worth saying, Josh, as well, that capital allowances can be fairly flexible. Some people think that they can only be used against the property's profits, which they can in certain circumstances. But nevertheless, that's brilliant, because if you've got a £40,000 capital allowances on a property and you're going to make £10,000 profit a year, then you could just roll that forward and not pay any tax for 4 years. So that's very valuable. But one of the other great things about capital allowances, which is quite rare in the tax world, is that you can use the allowances against other income that you have as an individual. So very often people have a job where they pay tax through PAYE, but they also have investment property. And by using something called sideways loss relief, you can claim the allowances in your property and offset it against the income that you get from other sources. And I'm sure when you do your tax returns for your clients, Josh, that's one of the main things for saving tax for people.
Yeah, 100%.
So yeah, sideways loss relief is great for capital allowances. So just talking about the worth of the capital allowances, one, knowing the type of property you're buying, the structure that you're buying it in as well, and your tax rate, the purchase price, and if those allowances are going to be rolled forward against future profits, or they want to be utilised in all at once now against other taxable income, which could be great for sort of short-term cash flow as well. What we sort of see for these properties is most people don't know about capital allowances. The amount of properties that we've seen in the last 12 years of doing this, where the previous owners are aware of capital allowances, is, it must be less than 1% of property transactions that we see the previous owners have claimed any capital allowances. And I mention that because you can only claim capital allowances once in a property's lifetime. So that sort of comes on to my next point about how do you get these capital allowances? Because this is wonderful, right? This huge amount of tax relief that you can identify on these properties. But the trick is now, how can you get that and how can you make sure nobody else has claimed them? So there's a few things to be aware of. So first of all, the property that you're buying, you need to have a look at who you're buying the property from. And that can determine whether or not they may have claimed allowances. Now, typical sort of transactions these days are people buying residential properties and then converting them into serviced accommodation or holiday lets. Very popular. Now, the sort of process for that is you need to look at the previous owner. Could they claim any capital allowances? Well, in this particular case, they couldn't, because it's a residential property, and residential properties you're not allowed to claim capital allowances on them because they're dwelling houses. So therefore, the previous owner couldn't claim any capital allowances, so you get them by default as the new owner, as long as you start trading it as a qualifying activity. So holiday let or HMO or serviced accommodation unit. If you just keep it as a regular buy-to-let, then there's no capital allowances because it's a dwelling house still. So that's kind of one scenario. Likewise, if you're buying a property from somebody who is outside of the scope to tax, then you by default get the capital allowances anyway. So a number of people that I know are actively buying properties from people who don't pay tax in order to get the benefits straight away. So then you start looking at society and the various groups and say, well, who doesn't pay tax? So pretty straightforward. The local council, the local authorities, they don't pay tax. Anybody who's buying property from them automatically gets the capital allowances. Fire stations, police stations, clients of mine are buying because, again, owned by the local authority, they don't pay tax, so you automatically get the capital allowances. Properties owned by charities and pensions as well tend to be larger properties, but if you're buying a property from those entities, they don't pay tax. So provided they've owned it for a number of years, then you get all the capital allowances straight away. I'm kind of simplifying a number of things today because it is quite a complex area, but in general, if the previous owners couldn't have claimed, then you automatically get the capital allowances. But then that kind of leads you on to the next point to say, well, okay, what if the previous owner could have claimed the allowances, whether they did or not? If you're buying from an individual, or you're buying a ready-made HMO or serviced accommodation unit or a holiday let, or a commercial property from a limited company, they could have claimed capital allowances. Chances are they haven't, but you never know. They could have claimed capital allowances. So there's a few things that we should have a look at further here. And one of these, if you're buying a commercial property, is this. CPSE inquiries. It's a standard document which goes between solicitors when you're buying a commercial property. And it covers a whole host of things. So the CPSE inquiries, the commercial property standards inquiries, solicitors see them every day. And it just mentions there's 32 different sections on the newest version, and it covers things in terms of leases and all types of sort of land registry document numbers and all sorts of agreements on the properties. And one of the sections of it is section 32, and that is specifically for capital allowances. So if you're buying a property and you get involved in the commercial, the CPSE inquiries through your solicitor, you'll see section 32 has got capital allowances. And that's a really good place to start, because invariably in that section, it will mention if there any capital allowances have been claimed or not. However, lots of the time, because the vendors don't know anything about capital allowances, a lot of it is just zeros or question marks or not applicable. But that's a good sign, because if the seller has claimed capital allowances, then you're going to see the evidence of that in the CPSE inquiries that they have claimed it, and in the sales contract as well. So have a look at these inquiries in association with the sales contract that your solicitor has got, And if they've been advised properly and they have claimed capital allowances, it'll be splashed all over the contract. And you should be looking out for things that talk about elections, £1 elections, talking about writing down values, anything that mentions something to do with the tax or the elections. That's something that you should ring a little bell in your head. So what's the best thing to do is have a look at those. That will determine whether or not there's an election has already been made. Now, in the contract, that's what's going to be binding. So if you find that there is a restrictive clause in the contract which stops you from claiming capital allowances, that's not necessarily the end of the world, because there's a few things that may have happened. One, which happens more often than not, the solicitors have put this clause in just to cover their own backs. The client hasn't claimed any capital allowances at all, but the solicitors just put this clause in there just in case they have, and there's no comeback on the solicitor then. So we can normally go back to the solicitor and ask for evidence of what's been claimed in the capital allowances, just to see if they really have or not. But even if they have claimed capital allowances, there's still no harm in you going back to them and perhaps renegotiating the sales price, because you're not getting this tax relief anymore, so therefore your net investment has increased, and there could be a sort of discussion around reducing that sales price to you. It doesn't have any impact on any development works that you're having on the property, because you can still claim capital allowances on that new spend that you've got. But just be aware, when you're buying that property, if it's a commercial property and the previous owners have stated in the contract that there's capital allowances that they've claimed, you may not be able to claim them. Even if that's the case, there's still a few peculiarities with the legislation that you could still claim some capital allowances. For example, if they've owned it since before 2008, there's a certain group of assets that they couldn't claim capital allowances on that was introduced in 2008, and you as the new owner are the first person to own that property since 2008, so you can make the capital allowances claim irrespective of what it says in the contract. And that covers sort of newer identified integral features, which gives you about 4 or 5% of the purchase price as an additional claim, irrespective of what the contract says. So just to be aware that if you're buying properties where the owner could have claimed allowances, that needs to be done and managed in a very different way. Now, there is a definitive list of everybody who has claimed capital allowances on every single property ever in the country. And that's really good news. The bad news is, unfortunately, that it's owned by HMRC, and they just don't disclose that to anybody. I know, because I've been asking for the last dozen years to get a copy of that. But the onus of responsibility is then on you as the new owner to find out if you can claim capital allowances on the property. Now, a lot of this happens at negotiation time. So you come across a property and you speak to the owners, you might get a draft contract. It doesn't say anything about capital allowances. So it kind of leaves you in a sort of precarious position, because you might want to go to the previous owners, the sellers, and say, look, I want to claim all this tax relief. Have you claimed any capital allowances? And that could potentially be quite dangerous, because you don't necessarily want to alert the sellers to this massive tax relief, because they could go away and claim the capital allowances, and then you'd be left without that opportunity. In my sort of experience, that generally doesn't happen. Most people, when they're selling a property, they have no idea about capital allowances. They don't really care about capital allowances. They just want to get the sales price they want for the property and kind of sell it, move on, or retire, or move on to the next project, whatever it might be. So that's quite good in terms of it gives you the opportunity to put the right clauses in the contract so that you can claim all the allowances. And that's kind of the sort of crux for today, I would say, that if anything, what you should take from today is you need to deal with the capital allowances at transaction time, so that you, the new owner of the property, can get the capital allowances if there's a remote chance that the previous owner could. What we typically do is, in these scenarios, is we get a clause put in the contract, which means that the seller will agree to the capital allowances value that we identify, and you as the new owner is entitled to claim those allowances. So each of the typical sort of scenarios are, people buying from a limited company, an office, or some other commercial building that they want to convert into serviced accommodation or flats or HMO. That's a scenario happens. Check the CPSE inquiries, check the contract to see if there's any restrictions on capital allowances. You can always potentially renegotiate with the seller, or you can put the clauses in the contract, which means you as the new owner is going to get it. People buying existing HMOs or existing serviced accommodation units to then still trade as serviced accommodation, same scenario applies. The previous owner could have claimed allowances, but some people have good relationships with the seller. They want to, kind of have good relationships, and they want to do the right thing, look after them as well. They might be sort of distressed sellers, or they might be incentivized to work with you in a sort of positive way. And if you have that open dialogue with the seller, then there's no reason why you can't get that agreement in place directly, rather than putting it in the contract. But either way, if you can deal with it at transaction time, that's an awful lot better. But there's always going to be situations, Josh, where people say, right, okay, I think the seller's a bit savvy. I don't want to mention capital allowances because I don't want them to get it. I don't want to miss out. So, what's the best situation there? Well, if you can't deal with it at transaction time, that's not the end of the world, because there's a dedicated process that means that you can go through completion, don't mention anything about capital allowances in the contract. And there's a process involving the first tier tax tribunal where you can apply for them to adjudicate on the capital allowances value for that particular transaction. Now, that sounds quite scary. And in reality, it is purely an administrative process whereby we have to fire off to the tribunal evidence of the buyer, the seller, the sales contract, the valuations that we do on the property, send that all off. They will then write to each party confirming this. They'll also write to the revenue to see if the vendors have claimed any capital allowances. And if not, that all comes back to us, and then you as the new owner would be able to claim those allowances. I will be honest with you though, given the fact that we've been in lockdown for pretty much a year, and the courts have been pretty much clammed up and closed as well for that duration, it's a very, very slow process. But nevertheless, it is a dedicated process. And as long as you do that within 2 years of the completion date, then it's fixed. You're allowed to go through that process. So I just kind of wanted to briefly talk about the fact that when you come across a property transaction, look at the value of the capital allowances, and then also look at the opportunity for you to claim. If you're buying from somebody who couldn't possibly claim, brilliant. That makes your life a lot easier. If you're buying from somebody who could have claimed, or it's already a trading property, then you have to go through this process of getting an agreement with them, generally in the contract. But if not in the contract, you could do it retrospectively by this external process. And it's just making sure that that's done within 2 years. If you don't do that within 2 years, guess what? Nobody gets any tax relief. You as the new owner aren't entitled to any, and nobody else in the future is entitled to claim any capital allowances. So that's the real cutoff. 2 years from that point is when the capital allowances are lost at that particular point. So look at the inquiries that goes between solicitors if it's a commercial property, a commercial contract. If not, just look at the regular contract. You can put a clause in there which I can send to you so that the seller is duty bound, is contractually obliged to agree to the capital allowances that you identify, and then that's the way to get hold of those allowances so that you can actually get that benefit. But as I said, Josh, just being aware you've got to get it agreed. If you don't get it agreed, yes, you can do something retrospectively, but it's time consuming. And it's much better to have it done when you're negotiating the contract. The seller's motivated. They want to get the deal over the line. They'll generally help you out and want to agree things. So that's when they're motivated to do so. As soon as they've sold the property, forget it. We write to them and they're just not interested. Certainly when they send them a letter and it mentions about tax and your accountant and, they're just not interested in getting involved. So they just want to move on and do that. So it's much better to get it done at completion contractual stage. But if that's really a risk, go through completion without getting any agreements on capital allowances, and then we can deal with it retrospectively. So that's kind of how to get the allowances. In terms of the process, I've pretty much covered most of that anyway. But in terms of the process, it is very straightforward in terms of we need to do our due diligence on the property. So even if you've bought a property within a couple of years, we can still look at that and go, let's have a look at the sales contract to make sure there's no restrictive elections in terms of you not being able to claim any allowances. Let's look at the CPSE inquiries to see if there's anything mentioned in there. If you're still able to claim, or potentially there's a claim there, obviously we need to look at who you bought the property from. Was it a residential property? Fine, there might not be any further due diligence required. We may need to go back to the previous owners, write to them, explain what we're doing and why we need their agreement. We need to obviously do the surveys on the property, and they need to be valued, and we need to provide the valuation reports so that you, obviously, Josh, can include those within the tax returns and get the tax relief. And then obviously disclose all the information through your tax return as well. So the process is pretty straightforward. Do the due diligence on the transaction, on the previous owners, go through the survey process, generate the reports. The reports then go into your tax return, whether that's your corporation tax return if the property is owned by a limited company, or if it's in your LLP return, or if it's in your individual SA 302 tax return, so that they can then use the allowances and get the tax relief there. So a couple of things I will just say before sort of wrapping up that bit, before we go to questions, is one of the good things about capital allowances, which I'm kind of constantly amazed by this, that I often tell people that even though you've done your tax return, I'm sure lots of your clients have just signed off on it on the 31st of January, literally last week. That was for the April 20 year, but not many people are aware that you've still got another year to make changes to that tax return. So even though you've submitted your tax return, if you had a property in April 20, you can still claim capital allowances in that tax year until January the 31st, 2022. So it gives you a lot of opportunity to go back and retrospectively claim capital allowances. So that's quite good. Get your tax back if you've already paid those and you have those properties. And kind of going full circle now in terms of if you did have one of these properties and then you decided to sell it, then what I would say is you need to speak to me and have the clauses in the sales contract so that the new owner can't claim the capital allowances that you've already claimed in your tax return. Now that's kind of what you're looking for when you're buying a property. When you sell a property, you should put a clause in the contract that says, I'm selling you the property for the price that we agreed, but the plant and machinery part of it, I'm selling to you for £1. So that means the new owner is not entitled to any of your capital allowances that you've already claimed on. You're limiting their rights to claim any of that tax relief on there. So that kind of protects your position. And that's exactly what you're looking for, or what you're being aware of when you're buying a property in the contract. You don't want to have that restriction, because that stops you as the new owner from claiming that tax relief as well. So I think just a quick sort of 25 minutes overview of the value of capital allowances there, the actual process on how to get the capital allowances at negotiation, contract stage, what to look for. Are you buying it with the owners potentially have already claimed and getting some agreement in place? 99 times out of 100, Josh, it's pretty straightforward in terms of the seller doesn't know anything about capital allowances. They're happy to put a clause in the contract because it doesn't cost them anything. Their sort of their naivety, for want of a better phrase, is that they haven't got this tax relief. It's not they're missing out, but then you as the new owner are benefiting from their from that particular tax relief. But it's not costing them anything to sign that clause in the contract, and it means you as the new owner can factor in the values of those allowances into your forecasting and sort of reduce your net investment in that particular property. So so that's kind of how to get the allowances. And then the process, as I said, in order to make a claim, we need to do our due diligence on the previous owners and the contract to see if anybody could have claimed the allowances before, looking at the inquiries, looking at the sales contract, go through the surveying, the valuation process, and the reports that we generate go through the tax return, and you get your tax relief as far as that's concerned. So yeah, typical sort of properties we look at are if they're owned in a limited company, yes, the limited company can still claim the capital allowances. Corporation taxes currently at 19%. I would suggest that it might be increased in the future years to help pay for the pandemic and everything. Not that I know anything, but I would imagine that goes up. So that, in theory, could be more valuable in the future. If you own a property personally or through an LLP or jointly, then you're entitled to claim capital allowances, and you may relieve tax at a higher rate. Some people buy commercial properties in SIPs or through their SAS pensions. Obviously, they're outside of the scope to tax, so they don't benefit from capital allowances. So just be aware of that particular transaction. And yes, speaking, I'm sure, Josh, you advise people accordingly, depending on how they want to maximise their tax relief on there as well. And the only other thing I will say, which I did sort of mention previously, in that claiming capital allowances on the purchase of a property no way impacts the ability to claim on the development works. And in fact, generally, the development works tend to yield higher capital allowances because a lot of that is just new plant and machinery going into a property. So they tend to be better for capital allowances, and you can almost ignore the purchase process when you're looking at the development side of things. So that's kind of a brief sort of summary of everything there. Josh, I'm sure there's some questions that we can tackle as well.
Yeah, absolutely. Yeah, thank you. I think we've got quite a few questions come in. I'm not sure where to start. So yeah, you covered a lot there. Thank you very much for that. So let's start with the first one. So I suppose, Thomas, you kind of covered it a bit anyway, but it's literally Paul. So there are offer stage at the moment for a £300,000 HMO. What do they need to inform the vendor, the purchasing for a limited company?
Yeah, so this is a sort of scenario. If you're buying an existing HMO, you've got to look at the contract to see if there's any restrictions on capital allowances. There probably isn't. Most people aren't claiming capital allowances because they don't know about it. There is an opportunity, or there is a chance that the previous owner could have claimed the allowances. You don't have to disclose anything to them, so you have a choice. You could either include the clause in the contract, which means that they will effectively pass the allowances over to you. By putting that in there, generally it's just signed off as a tax question, if you like, or confirmation from a tax perspective. If they do ask the question, then you can answer it by saying, look, the capital allowances are going to be available on this property. I want to get hold of that. If it then, sometimes they're not happy to include those clauses, which is perfectly fine. You can then assess whether or not the seller is motivated, just wants to get out and retire, or if they're savvy businessmen, they might want to look at capital allowances. You don't have to mention it to them. You can always do that retrospectively and go through the sort of FTT process that way. So again, a lot of it all goes down to who you're buying the property from. Are you buying it from somebody who is, as I say, motivated, doesn't really care about tax? A lot of people are getting out of selling a lot of people are selling their properties because they're generally not making profits. And certainly people who are investing in B&Bs and guest houses, lots of those just don't make profits. A lot of the reason is because they tend to run a cash business. I'm sure they declare all of their cash earnings, but they tend not to make huge amounts of profits on paper. So there's no point in claiming capital allowances because they've got minimal tax to wipe out. So again, knowing about the person you're buying from, the type of property, this HMO that you're buying for £300,000 might not be making any money. They have no need to benefit from the capital allowances. So they might be very happy, or more than happy, to sign off that particular clause in the contract, which makes your life a lot easier. So you're able to claim the allowances as soon as you take ownership of that property.
Yeah, I hope that answers your question there, Paul. So we've got one here from James. So do all of the capital allowances for a limited company also apply to a partnership? But yes.
Yeah, so the capital allowances on a property is exactly the same. So if there's a £200,000 property, rule of thumb, there'll be about £40,000 worth of capital allowances. Now, the value of those capital allowances depends on who owns that property. So it can be claimed whether it's in a limited company or whether it's an LLP or joint venture or partner, whatever it might be. The value of capital allowances will always be the same. What the tax relief, if it's in a limited company, is obviously at 19%. So that £40,000 will save you £7,600 off your corporation tax bill. If it's owned through an LLP, each member is entitled to their share of profits, losses, and capital allowances as well. And then you can use those allowances against other income potentially that you have as an individual once it's gone through the partnership return. And the same as if it's owned by a couple, for example, or joint venture, or if it's jointly owned by somebody, they're each entitled to their share of the profits, losses, and capital allowances as well. So irrespective of who owns the property, the capital allowances will be exactly the same. The actual cash value of those allowances is dependent on the tax rate of the owner, if that makes sense. So yeah, it applies to limited companies as it does to individuals. So yeah.
Perfect. I hope that one's answered your question there, James. Let's pick a couple more. So Paula here, I've had an offer accepted on a large HMO, which I'm planning to extend and split into three lots of 5 beds, so 15 in total. There's a bungalow in the grounds to make another 5-bed HMO and land to build yet another. Wow. Yeah, I was going to buy it in an SPV, but what structure should this be, limited or LLP? So it's quite open-ended question there.
Yeah, I mean, this is where your expertise, Josh, comes in, because I can comment what's best from a capital allowances point of view, and that will always be through an LLP or individually, because the tax rate that you can save at is going to be a lot more than in a limited company at 19%. But that's just from the capital allowances point of view. What your accountant or Josh will do is we'll look at your overall position and say, well, okay, yes, you have these properties, but you've also got other income, and you've got savings and dividends and interest and all these other things that are going to impact that. And so it might be that already you're paying huge amounts of tax, and it might be the safest thing to do, certainly with other people involved, or maybe finance as well, that setting up a limited company is the safest thing to do. But from a capital allowances point of view, yeah, I can comment on that, but your accountant obviously will need to look at your overall position and then advise what's best from that perspective. So every situation is completely different, and we just need to look at your overall position rather than generalising and just saying always go for this or always go for that. It very much depends on your own circumstances, I would say.
Yeah, 100%. I definitely agree with that, Paul. Let's speak to your accountant just to see what's best on balance. So who else we've got? Harris. So do you have to claim against profits in the company?
So this is one of the nice things, actually. So let's say that you own a property personally. And what you should do, what you will do is, if you've got capital allowances on a property, on a new property, then first of all, you will offset those capital allowances against the profits of your property business. In the first year, for example, they tend to have lots of capital allowances and not much profits because it's a new business. So then you have an option. You can either take those capital allowances and then roll them forward and offset them against future profits, which you can only do in a limited company. But if you had it in your own name, you then have the other option of using those unclaimed allowances against your other taxable income. That means you can't then roll those allowances forward against future profits, but you're getting the tax relief against other income now. So they are flexible in that respect in terms of what do you want? Do you want to have long-term cash flow benefits in terms of not paying tax for a number of years, in which case just roll forward those allowances to offset against future profits? Most people, I would argue, want the short-term cash benefits in terms of they've claimed the capital allowances, they've offset as much as they can against profits in that property, and they're then using those excess allowances against their other income and getting tax back that they paid on that. But then you might look at it and say, well, hold on a minute, I'm only paying 20% tax right now, and then in the future I might be paying 40% tax. So maybe I want to have a combination of doing both, maybe rolling forward some allowances and then not claiming them all, but maybe You can claim a writing down allowance and then use that as sideways loss relief potentially in the future. That gets a bit more complicated, but they are flexible to a certain degree. And again, speaking with your accountant, speaking with Josh and looking at your situation, he can advise on the most tax efficient way to benefit from those allowances. We can sort of go through the due diligence, identify, value the capital allowances and give you an indicative idea. But Josh is in a much better position to look at you individually and all of your sort of different streams of income and investments and comment on a sort of general bigger picture perspective, if you like.
Yeah, absolutely. Cool. So we've got time for probably one or two more. So we've got a couple of questions all around the kind of social housing, supported living side of it. So essentially, can a supported living accommodation, class C2 equivalent, be subject to capital allowance if converted from residential to flats to cater as such? And it'll also have a small office inside for a carer.
Yeah, so we do work with quite a few companies which provide these services as kind of halfway houses, if you like, where they operate rooms on a sort of nightly basis. Sometimes maybe people are there for a couple of weeks and on the emergency basis as well. And you've got dedicated staff in there, as you rightly said. There's normally 3 or 4 people rotating throughout the day and support staff as well. And so yeah, all those kind of units, whether you're providing services generally let out to the council or to sort of charities who operate those properties, then yes, short-term rentals they're not long-term. It's not somebody's main property, it's not their principal residence. So in that particular case, yes, you're able to claim the allowances. The value of those allowances, as I sort of said, is look at how much you bought the property for, have a look at your capital investment in the property, the development works as well, and how you're structuring that particular ownership. And that can give you an idea of the allowances also. But yeah, those kind of properties very often are great for yielding pretty good capital allowances. And the reason for that is because lots of them tend to be fairly well serviced in terms of there's fire alarm systems that are installed there and they've all got their ensuite facilities. So it's a nice, safe environment. And the more plant and machinery you put into a property, the bigger your claim is in terms of the development works. And very often people are buying guest houses, old B&Bs, which are already fitted out to that particular spec. They're already spec'd up with individual ensuite rooms. They perhaps just might need new sort of sanitary ware, bit of decorating, new locks and the like, and you've got a ready-made unit set up, ready to go. So yes, those properties qualify also.
Yeah, perfect. So I hope that's answered that, Yoko, and a couple of other people answer about that as well. So definitely look into those capital allowances, speak to Arthur, save some tax at the end of the day. We've got time for one more. Let's have a look. So I've got one here. If I take on the beneficial interest over a property in a divorce, which was a family home, but is now run as SA/commercial, can I claim capital allowances on this?
Yeah, so this comes up fairly regularly, and it's also if you do like a deed of trust to say, well, okay, who is actually benefiting from the property, and if you look at the planning status is irrelevant, by the way. So irrespective of what the planning status is of any property, whether or not you're entitled to claim capital allowances is dependent on how the property is traded. So generally, you look at a property and you say, who is the legal owner of the property, and they are the ones who are able to claim the allowances. So generally, if it's a limited company that owns the property, they're the ones that are able to claim the allowances. If it's owned by a partnership, then the partnership is entitled to claim, and each member is then entitled to their share. And if it's owned jointly, for example, then each individual owner is entitled to their share of the allowances. And of course, people do put in deeds of trust for people to take ownership and operate the property. And then you've got to look at who's benefiting from the risks and the rewards of that particular property. So yeah, potentially whether you've got this agreement or whether you've got something that demonstrates that you are taking the risks, you're benefiting from the rewards, potentially there is the opportunity to claim capital allowances on those properties. But again, we need to have a look at the agreements that are in place just to make sure you're not excluded from making a claim for these allowances, and look at previous ownership of the property as well.
Yeah, Perfect. So I suppose really the main thing is just make sure that you're thinking that our capital allowances available, and just speaking to somebody like yourself who's able to say yes, no, let's look into things, but just make sure that you are thinking about capital allowances. Because at the end of the day, I'm sure you'd rather kind of speak to someone for 5 minutes on the phone and say, you know what, this time it's not available, but here's what you need to look out for next time, because ultimately everyone will be saving tax in the long run.
Exactly so. Yeah, there's no harm in having a quick conversation about it. But as I said, thanks for talking to me this evening, Josh. But I think if anything from today, people should take away, it needs to be dealt with at contractual stage. When you're completing, ideally that's when the capital allowances, if there are any available, and the previous owners could have claimed them, that's when it needs to be dealt with. And for the sake of a quick phone call, we can talk through the process and go from there. So I hope everyone's learned a few little
definitely been really good. So we've got your email address here. It's ak@exactca.co.uk. Is that the best way for people to contact you?
So drop me an email, and then I'm more than happy to have conversations with you, or visit the website exactca.co.uk. There's more information there and contact details as well. So more than happy to have a conversation with them.
Perfect. It's been a pleasure having you join us. I hope everyone's got lots of value from that. I'm just going to try and reclaim host status to see if it lets me get the recording. That was easy and painless. And your video's still there. Perfect. So thank you very much for joining us, Arthur. It's been a pleasure. And thanks to everyone else for coming on with us and listening to Arthur talk about tax, especially on a Tuesday evening. I'll try and send this recording around to the people that have asked. Otherwise, thanks for joining us, guys.
Yes, thank you.
See you, Arthur. Bye.
Thanks.